Welcome back everyone for another look at what's happening in crypto around the world. Now we spend a lot of time covering goings-on in the United States, but today it's time to forget about debt ceiling debates, Fed rate hikes and Ripple versus the SEC, and instead turn the focus elsewhere. So, join me for a look at some headlines from some other corners of the cryptoverse. We don't have to travel far from the US for our first story though, just across the border into Canada in fact. Canada, as you may know, is where Binance CEO CZ hails from, but that hasn't stopped his exchange from packing up and leaving the country. On the 12th of May, Binance tweeted that it would, quote, be joining other prominent crypto businesses in proactively withdrawing from the Canadian marketplace. Unfortunately, new guidance related to stablecoins and investor limits provided to crypto exchanges makes the Canada market no longer tenable for Binance at this time. Now, this follows the introduction of new guidance by the Canadian Securities Administrators, CSA, back in February that puts significant constraints on how Binance and other crypto exchange platforms can operate in the land of Mounties, maple syrup, and moose. Now, it seems that Binance had initially attempted to comply. When Bloomberg reported on the matter back in April, it stated that the new rules called for, quote, unregistered crypto trading platforms operating in the country to commit to a so-called pre-registration undertaking. Firms are required to follow tougher regulations on segregating customer assets and prohibited from offering margin or leverage to users in Canada. Now, other operators such as OKX, DYDX, and Paxos had already signaled their intent to leave the country, but Binance did reportedly file that pre-registration undertaking before giving up the ghost. Users now have until the end of September to close out their positions and find alternative platforms. Now, this move by the CSA could well be related to the news that the development of Canada's central bank digital currency, or CBDC, is continuing apace. Earlier this month, the Bank of Canada announced a public consultation for its CBDC, which follows earlier such consultations on crypto and stablecoins. According to CryptoSlate, quote, the bank is primarily interested in learning about how Canadians would use the digital dollar, what security features are crucial, and what concerns citizens with regard to CBDC's accessibility and privacy. The announcement also noted that cash usage would remain the same even if the Canadian digital dollar is rolled out one day. Crypto, and especially stablecoins, are viewed by many central banks and governments as direct competitors to CBDCs, and it's no surprise then that the crypto industry in Canada is coming under pressure as a result. That said, it does seem like the Bank of Canada is at least making a decent effort to give Canadians a say when it comes to their CBDC, which is more than can be said for other countries. That famed Canadian politeness, eh? Meanwhile, Binance is also finding itself under the cosh in Australia. It suffered a double whammy last week when Westpac, the country's oldest bank, announced a ban on transactions to a number of crypto exchanges, including Binance Australia. This came on the same day that the exchange was forced to suspend Aussie dollar services after its payment provider withdrew its support. It's part of an all-too-familiar tale, sadly. Authorities in Australia, as in many other countries, are getting spooked by crypto in a big way. Now, one of the reasons cited for this latest action against Binance is the amount of money lost to crypto scammers in recent years, which is certainly a big problem in Australia and elsewhere. It is worth noting, though, that cracking down on exchanges like Binance is not going to make that problem go away, nor does it do anything meaningful to crack down on the scammers themselves. Sure, it might inconvenience those scammers a little bit, but the real losers here are the ordinary upstanding people looking to trade crypto. Dig a little deeper, of course, and a familiar culprit emerges. Yup, CBDCs. The Reserve Bank of Australia is keen on them too. Coincidence? I think not. Anyway, it's easy to get hung up on countries like Canada and Australia that are struggling to get to grips with crypto while ignoring many other places where it's being used for a lot more than speculation and investment. In many countries, crypto is fast becoming a lifeline for ordinary people as they struggle to deal with levels of inflation way above what many so-called Western countries are experiencing. Argentina, the Philippines, and Turkey are 3 countries where inflation is running red hot and crypto ownership is surging as a result. As CryptoSlate reported, Turkey saw its levels of crypto ownership jump by 27% between 2021 and 2022, largely thanks to a peak rate of 72% inflation. Argentina trumped that, however, as its inflation rate peaked at just under 95% in 2022, causing crypto adoption there to surge by 23.5%. Inflation wasn't nearly as high in the Philippines, peaking at around 8% in late 2022, but the country still saw crypto adoption rise by 23.4%. While crypto remains primarily a speculative asset in many countries, elsewhere it's becoming a part of everyday life as people become increasingly tired of their fiat shitcoins and turn to currencies that can't just be printed at will by their governments. Expect this trend to continue and keep an eye out for increasing levels of innovation coming out of these countries that are really putting crypto to good use. Chances are future crypto use cases and super apps could come from somewhere like Argentina, Turkey, or the Philippines. But back to a country where most of the focus is on regulations. Now, the UK was on the list of places we visited in our last look at crypto around the world, and I'm afraid it merits a stopover this time too. That's because of a couple of bits of recent news. First up came the recommendation by the Treasury Select Committee that the UK government regulate crypto trading in the same way as it regulates gambling. The old chestnuts of, quote, no intrinsic value, huge price volatility, and no discernible social good were trotted out to back up the committee's reasoning. This threw a bit of a spanner into the government's plans to regulate crypto in the UK, which we summarised in a video a few months back. Link is below. TLDR, the proposed regulatory framework for crypto in the UK is very promising, albeit potentially subject to changes which could make it less so. But there's clearly opposition from many quarters, which means that the signing of regulations into law may not be a straightforward process. However, a few days after the Select Committee had made its feelings known, a contradictory view was expressed by the International Organization of Securities Commissions, IOSCO, a watchdog group made up of regulators from 130 jurisdictions and one which I must admit I'm not all that familiar with. IOSCO, which includes the UK's Financial Conduct Authority and the US SEC among its members, called for the UK to regulate cryptocurrencies, quote, in the same way as traditional assets such as stocks and bonds. According to The Guardian, doing so, quote, includes requiring trading platforms to publicly disclose how they vet crypto assets before allowing them to be traded, clearly explain how they store and safeguard clients' crypto assets, and ensure they are separated from the firm's own assets that might be used for proprietary trading. In short, then, a lot of compliance would be required from exchanges and other similar platforms, which makes sense in the wake of the collapse of Celsius, Voyager, FTX, etc. The view expressed by the Treasury Select Committee, however, is that regulating crypto in the same way as other assets would create a, quote, halo effect, which could mislead consumers into thinking that investing in crypto is safer than it actually is, which I think kind of misses the point. I would argue that anyone investing in crypto is well aware of the risks involved, and that treating it the same as gambling would merely encourage people to act even more irresponsibly than many of them already do. That said, of course, gambling isn't taxed in the UK, so if the Treasury Select Committee has its way, well, I'm sure many would be absolutely delighted. Okay, time to end this roundup on a high note by stopping off in Hong Kong. As I'm sure you're all aware, retail trading of cryptocurrencies will become legal in the China-controlled city-state very soon, and in just a few days' time, on the 1st of June, exchanges there will be able to apply for a license from the city's Securities and Futures Commission, SFC, to operate. Now, a few things to be aware of before you get too excited. First up, It looks like only the major cryptos like BTC, ETH, and a few others will be accessible to investors in Hong Kong. As Bloomberg reported, quote, individual investors can trade larger coins on exchanges licensed by the SFC under Hong Kong's new approach. Safeguards include knowledge tests, appropriate risk profiling, and reasonable limits on exposure. The coins should be included in at least 2 acceptable investable indexes from independent providers, one with experience in the traditional financial sector. Now, it's unclear which cryptos besides BTC and ETH meet this criteria, but the list is likely to be limited. So, although retail traders will be able to invest through licensed and heavily regulated exchanges, only a handful of larger cryptos will be accessible to them, and they will likely be heavily vetted by said exchanges in order to satisfy the powers that be that they know what they're doing. So, don't count on a flood of inexperienced newbies piling into SHIB on the 1st of June, in other words. Now, of course, the really big question here is just how much pent-up Chinese money is going to find its way into the crypto market via Hong Kong. China is notorious for its strict capital controls, and the CCP will not be keen to see a flight from the yuan to BTC, ETH, and others. Inflows from the mainland are likely to be restricted and closely monitored. That said, this could well mark the beginning of a pivot towards crypto by China, as it looks to capitalize on the US's rejection of the industry. As I and many others have been saying, the next bull run could well begin in the East, and so we need to watch what happens in Hong Kong over the coming weeks and months very closely. But let's leave the last word on this to Mr. Binance himself, CZ. On the 24th of May, he tweeted, quote, CCTV, China Central Television, just broadcasted crypto. It's a big deal. The Chinese-speaking communities are buzzing. Historically, coverages like these led to bull runs. Not saying past predicts the future, and not financial advice. I couldn't have put it better myself. Thanks, folks, for watching this roundup of crypto news from around the world. And if you would like to see more news roundups like this, do let me know in the comments below. Also, be sure to check out the Coin Bureau deals page, which is down in the description, for some amazing trading fee discounts on some of the top exchanges and discounts on hardware wallets as well. You would be insane not to check it out. Thank you so much for watching, and I will see you next time. This is Guy bidding you goodbye.